everyone. This is Randy Pickerell with Diversified Capital Funding, here today to talk about a question I frequently get from both seasoned borrowers and from first-time home buyers, and that is, how does qualifying work? Well, qualifying is just a simple calculation where the lender looks at the relationship of your monthly debt load and whatever you're proposing for a new house payment. And that new house payment must include the mortgage payment, the property taxes, the insurance, private mortgage insurance premiums if you're paying any of those because you're putting less than 20% down, or homeowners association dues if it's a condominium or a townhouse, or a single family home that might be placed in a development that has some common amenities. So add that all together and that equals your housing debt. And what a lender will do is then they will divide the total housing payment by your gross before tax monthly income. And lenders like to use only your stable ongoing income. They don't like to use income that fluctuates all the time. But if there is fluctuating income types such as overtime income, bonus income, and to a lesser extent, restricted stock unit income, then there are methods to average that type of income and add it to your base level income and use it for qualifying as well. But again, we come in with a determination of the total income number and the total debt number. And then we also look at, from your credit report, any other debts that you might have, such as minimum payments on credit cards, student loans, installment loans of any type, whatever shows up on a credit report typically is added to that proposed housing payment. Then we divide by your gross monthly income, your before tax income, and that equals your debt to income ratio. And generally, a benchmark for that is it should not exceed 45% of your gross monthly income. Jumbo lenders are typically more conservative, and they may only allow a 43 or even a 41% total debt ratio. And some other types of loans, such as FHA or Veterans Administration loans, have a little bit more flexibility and will sometimes go up to a 49.9% debt ratio, and sometimes even higher than that. But typically with a conventional conforming loan product, you're not going to get an approval over 49.99% debt ratio. There's a hard stop in the system that typically prevents that. So let's take a look at this using the spreadsheet that I use for qualifying purposes all the time. This is a spreadsheet that I use on a daily basis to help my borrowers understand their maximum qualifying power, or if they qualify for a particular purchase price and loan amount. So you can see I've plugged in a $1 million purchase price, a theoretical 5.5% interest rate, a loan term of 30 years, and an 80% financed amount of $800,000. That yields a mortgage payment of $4,542.31. We've estimated property taxes at the average tax amount for my local city and county, which is about $1,041.67, and estimated homeowners insurance of $125 a month. We have no private mortgage insurance premiums plugged in due to the 80% financed amount or the 20% down payment. It's not required in most cases. And we don't have any homeowners association dues plugged in because the property is not part of any development for which they pay HOA dues. So the grand total monthly payment for the house is $5,708.98. Now, if the borrower has other monthly debts, and you can see in this case I've plugged in $500 a month for possibly a car loan. The way we qualify a borrower is we take this $5,708.98, we add to that the $500 in other monthly debts, and we divide by their gross monthly income. Now, in my spreadsheet, even if I have no income plugged in here, I can go over to this table and I can see that if I've plugged in a maximum debt to income ratio of whatever the loan requirement might be, in this case 45% for a conforming conventional loan, which is typical, then it tells me the borrower's monthly income needed to qualify, and then it also converts that to the annual income needed to qualify. So that's where I got the $13,798 number, and plugged into the income. And that's how I got a total debt ratio of 45%. Now, this total housing ratio is just the house payment divided by the borrower's combined monthly income. That ends up being 41.38%, but the house payment plus $500 divided by $13,798 in total income is 45%. And that would be roughly the maximum qualifying power for this borrower if their income was $13,798 and their other debts were $500 a month. Qualifying is that simple. It's a simple math calculation.